Hi everyone, it's Caitlin and welcome back to Your Financial Journey. In the last videos in our credit card and loan series, we talked about good debt versus bad debt and credit scores and credit reporting agencies. In today's video, we're going to focus on how to improve your credit score, because improving your credit score usually means that you'll get a lower interest rate on the credit cards, mortgages, and loans that you apply for. As a refresher, 90% of lenders use your FICO credit score to decide whether to approve you for a credit card or loan, and also to determine the interest rate that you will have to pay on that debt. This table here shows you what FICO considers as an excellent, very good, good and all the way down to the poor credit score. Any score in the very good range or above should be your target. Because your FICO score is what most lenders use, let's look specifically at the 5 factors that impact your FICO score. Know that whatever you do to improve your FICO score will also have a similar impact on your credit score with Vantage, Equifax, Experian, and TransUnion. You'll see from this illustration that the 2 biggest factors are your payment history and the amounts owed. Taken together, your payment history and amounts owed make up 65% of your FICO credit score. Payment history refers to whether you make your payments on time. Your credit score experiences double-digit drops when you pay any credit card or loan installment more than 30 days after the due date. Your score drops further if you pay 60 or 90 days late. So yeah, please try to avoid that at all costs. Amounts owed refers to how much of your credit limit you've used. It's also known as credit utilization. The gold standard for credit utilization is 30%. So if you want your credit score to go up, try to keep your balances under 30% of your credit limit. This means that if your total credit limit is $10,000, if your bank or credit card company allows you to borrow up to $10,000 from them, then you should never borrow more than $3,000, not have more than a balance of $3,000 on it, as the bank says it. If your credit utilization exceeds 30% of your credit limit, your credit score will drop for sure. Even if you do nothing else, you'll improve your credit score by simply making your payments on time and keeping your credit utilization to under 30%. The third factor impacting your FICO score is the length of your credit history, which makes up 15% of your credit score. This refers to the average amount of time the accounts on your credit report have been open. It does not take into consideration any accounts that are closed or not listed on your credit report. All things being equal, the longer your credit history, the higher your credit score. So if you're not an overspender and tempted by credit cards in your wallet or lying around the house, don't close your old credit cards. So your payment history, paying on time, your amounts owed, keeping your credit utilization below 30%, and the length of your credit history, not closing out old accounts, doing just these 3 things already puts you ahead of the game when it comes to keeping your FICO score up, because these 3 factors combined make up 80% of your credit score. Moving on to the 4th impacting your FICO score, new credit, which makes up 10% of your credit score. New credit refers to the amount of new accounts you've opened or tried to open recently. Anytime you submit an application for a new loan or credit card, the bank runs what's called a hard inquiry on you, meaning they check your credit history and scores to make sure that you're trustworthy and will pay them back what you borrow in a timely manner. Now, any hard credit inquiry may temporarily drop your credit score by a few points, even if you have a good credit history, but it will only be for a short period of time. If your credit history is not so stellar though, a hard credit inquiry may have a bigger impact on your score. If you're looking to increase your credit score, make sure you keep those hard inquiries to a minimum. Too many hard inquiries over a short period of time is a cause of concern for lenders. Lenders worry when you try to open too many accounts over a short time span, because they start wondering why you might suddenly need to borrow so much money and whether you'll be able to pay everything back. Generally speaking, you shouldn't have more than 1 hard inquiry every 3 months. This is especially true if you're applying for a new mortgage or home equity line of credit or looking to refinance an existing one. You'll always know when there's a hard inquiry on your credit score because your lender, employer, or landlord will ask you to sign a document allowing them to run this search. They can't do it without your signature, your written permission. That's a hard inquiry. A soft inquiry is when you go on Credit Karma or one of those other personal finance apps to check your score. This you can do as often as you want and it will have no impact whatsoever on your credit score. Moving on to the fifth factor impacting your FICO score, and that's your credit mix, which makes up the last 10% of your credit score. Credit mix refers to the different types of credit cards and loans you have, such as personal loans, student loans, car loans, boat loans, and mortgages. Your lenders like knowing that you can handle different types of debt products well. In real life, though, I'm not so sure it's wise to take on more of different types of debt just to improve this credit mix factor here. It may be smarter to focus on trying to impact these 4 factors here, meaning try to pay your debt on time, keep your credit utilization below 30%, don't close your old accounts, and don't open new accounts too regularly. Okay, my financial friend, I hope you found this video helpful, and if you need a refresher on the difference between your FICO, Vantage, and other credit scores, then check out this video here from my sister Ava. Thanks for watching, and we'll see you again next time.